All right, talking about B2Gold, BTG on New York or BTO on Toronto. Having a good day today, up about 2.8% when I'm recording this. Made a nice little comeback this month. It's been rough for the last 6 to 8 months in gold, period, and not just B2Gold. But overall, B2Gold has actually done quite well. Over the last 3 years, the CAGR is 20%, and over the last 5 years, also 20%. So that's a great run in the stock. Last 6 months have been a little rough, but it's not because of the company. It's just sentiment on gold, and gold, coming back today. And I really want to start out just gold in general. I do think you should always have a little bit of gold, and you can play the cycle a little bit. It's not always easy to say where gold's going. It's a complex commodity. It's often used as a currency. Central banks own it. It's hard to see what the value of a shiny object is, though. There's a lot of issues with gold, but the number one reason that I usually own some is because it's uncorrelated with the rest of my portfolio. I just know gold can go up. When markets are going up, gold can go up. When markets are going down, gold can go down, and it can also do the opposite. And it just seems to be its own player, whereas a lot of stocks trade together. So we see gold's doing well this month, and we're doing well today while the market's kind of down right now. So it's a good time to talk about it. The other thing about gold is you kind of just gotta, in my opinion, is not get too hung up on the price prediction of it, at least, and just say, what is it today, and how much money do they make if the price stays roughly the same. And that's where I start to like B2Gold. So I know they do really well when gold is 1,700 or higher, or they actually got some room to come down. I know they do really well. All right, I'm going to jump into the model first, and here we go. And you can see, as I said, it's very cyclical. I do love how our model, the return on capital, is highly correlated with the stock price. The bars are the return on capital, kind of the lightest yellow is the actual stock price, and you can see it as rate of returns going higher, so as the stock returns come down, the stock comes down, and you got a nice correlation there. So if you're just following the change in return on capital, you're probably going to do okay just with the B2Gold and many golds. Obviously, we got a nice valuation here. That's always a positive, but it's certainly not the only thing you got to look at. It's a model. It's not perfect. The valuation is the hardest part. So I don't get too like, oh, it's just cheap. Just snap your fingers. Oh, okay, great, obvious. Let's buy it. No, that's too simple. But I don't hate it when the valuation is positive. I call it at least a check mark. So look, another thing on valuation while I'm on it, EV/EBITDA, it's only trading at 4.8 times. 4 times. I mean, you have to have a pretty dire scenario to not believe that B2Gold can earn this kind of earnings for 4 years or 4.8 years. I mean, that's really all you're paying for, and I think it can go higher. Okay, so that's all the good news. There's a little bit of bad news. They did a preliminary report on revenue and production, and it was a little light, frankly. But the market's kind of ignoring it. I'm going to jump in. I have some of the numbers here. Let's focus on this. Consolidated revenue was $362 million, down from $380 million a year ago. Okay, so it was due to 16% decrease in gold production. Okay, gold sold, so let's not quite. It's obviously related to production, but there was definitely lower production, and one of the reasons was it just wasn't as in a high quality part of the mine. So their strip ratios were higher, meaning they had to there was more waste, right? So you mine this and they measure it in tons, and you only get a few grams per ton. And in this particular year, the waste was a little bit higher than it was the year before. Now the realized price was better, so that's good. The realized price was average $17.91 versus a year ago $15.88. Okay, so look, overall, I'm a little disappointed that the revenue and the production was down and the ounces sold, but overall, I'm okay with it. I know it's cheap anyways. I know, I don't expect a mine to just be perfectly, up and to the right. This is just not how it works. As you can see, their strip ratio this time was a bit higher. It just wasn't as many grams per ton. They're still, taking out tons of ore, and it just wasn't as good a part of the mine. Maybe next year they hit a better part. They don't know. We don't know. Nobody knows. But we do know this: at $1,700 an ounce, they make a lot of money. In fact, let's get some costs here. I know I saw $500 an ounce. Okay, here we go. This is exactly it. Total cash costs are projected. Now, so this is their forecast to be $500 to $540 an ounce. So it only costs them $540 an ounce to produce it. They get $1,700. That's pretty good business. If you whatever business that is, it's pretty good business. There's another number that miners look at, or mining analysts look at. It's called all-in sustaining costs. So that's even after you replace, it's more like exploration and depreciation, those sorts of things. It's still $870 to $910 an ounce. So even if they replace all their production, they still make what? Well, the difference between $1,700 and let's call it $900. You're still making $800 an ounce there, right? It's really, really solid. Look, we know. I'm gonna go back to the model here for a second. We know the rate of return is up to 23%. That's, it's tied to the price. It's tied to the production. It all has to make sense. So the financials are showing us that they can earn a high rate of return at these prices. It's only trading at 4.8 times. Gold's an uncorrelated asset, so I'm trying to get all the points here. As you can see, gold hasn't done great in the last 6 months, but all of a sudden this month, gold's back in favor. The market's struggling a little bit. I think you got to have some. B2Gold's as good as any as I can find out there.